Hey guys, Dan Fitzpatrick here at Stock Market Mentor on February 7th. That's Tuesday. And in this video, we're going to go back to RenRen. And here's why. I'm not like beating on this stock or anything. You know what? It just gives us a really good running example of what these big breakout stocks do. And so I'm going to keep doing it until it stops conforming to the pattern. Right now, it is conforming to a pattern. And here's the pattern. First, volatility squeeze right here, a nice breakout. If you've been watching these videos, you should know all this, and I apologize for boring you, but I'm sure you'll learn to live with it. Then a breakout. Let me get the right tool for the right job here. A breakout to the upside, a little pause, and this was the big deal. This was the big move, but the thing is, it was a power move. I've talked about this before, where now it doesn't look like that much volume, but back before the big old spike the following day, this was like double normal volume. So you get the first big move, and a lot of folks would say, wow, I can't buy that stock now. Well, the next day, it just kept going. Again, this is a Facebook thing. I remember this very well because I was talking about this stock at the Warden workshop or seminar in San Diego. So we get a bigger move up, fine. This is what I would call one big old phase one of a volatility squeeze. A little sloppy because you could think, well, maybe that's phase one, and members, you know what I'm talking about. The first move higher out of a squeeze, second little pullback, and then bam, a big explosion to the upside. So we got that. And all we're really talking about is buying and selling dynamics. There's nothing magic to this. I'm telling you, aside from what you hear some folks, some of the folks on CNBC talking about with all their fancy lingo and all that, trading is not that hard. You just buy low, you sell high. Everything else is just nuance. If you're buying high, well, guess what? You better have a really tight stop on it, because otherwise you run the risk of buying high and selling really low. So with that said, here, instead of having this be phase one, phase two, phase three, we could really look and extrapolate more and say, well, this was all one big Facebook hype here. That was phase one, the initial push out of the squeeze, out of the box. Phase two is the pullback, searching for demand. You know, the demand ended right up here. Everybody got all the stock that they wanted. Now we're getting a pullback, and the question is, when is new demand going to come in and just soak up all the supply, all the profit taking? By the way, as an aside, how do we know that this is just profit taking and it's not out and out distribution, like just massive selling and shorting? Easy peasy. Volume on the decline. If this was big selling, big shorting, you wouldn't see volume declining. You would see volume picking up. I just threw you a huge pearl, I'm telling you, because if you can understand the relationship of volume with these big price moves, I promise you, you're going to get on the right side of more moves and absolutely stay off of the wrong side of more moves. So you're going to make more money, if for no other reason than you're going to lose less money. So we get this pullback here. It looks to me like now we're finding demand. For 2 days in a row, the stock has it's hit the low of 480 and then 482. So we're going to call it 480. So right now there's ample demand at 480. What we want to see, first of all, if you're buying this stock, I'm not telling you, I'm not predicting that the stock moves higher. I think it will. I'm long the stock. But what I'm saying is this is new demand here at 480. So I've got, what, 43 cents of risk. That's less than 10%, 43 cents of risk when the stock's at 523. So if you decide, well, I believe I'm up on Dan's thesis, I think that's true. So you buy the stock at 523, you keep your stop right underneath 480, call it 475. Okay, now you run the risk, by the way, of having this happen. Stock falls down, you get stopped out. Here's the 20-day moving average. The stock moves higher. Okay, here's the thing, and this is really important because I'm going to say it, 4 words. Too bad, so sad. The whole reason for having a stop here, guys, is to prevent this kind of thing from hurting you. If you have a protective stop, you are going to take the big loss out of the trade. That's what stops are for. I'll say it again. If you have a protective stop, you're going to take the big loss out of the trade. That is what stops are for. I'm digressing here, but I think it's important, and I don't care if you're a member or not. You've got to understand this stuff if you're going to stay in the game. If you're trading a stock like McDonald's, okay, it's in consolidation now, so maybe it's not the best example, but actually maybe it is. Okay, we're here on the weekly chart, so let me pull a weekly time frame here. Do you really need a stop on McDonald's? Now, if you're day trading or if you're swing trading, tight little trades, fine. But you know what? Actually, if you're doing that, you should be trading RenRen, not McDonald's. This isn't the stock to be trading. This is a stock to be holding. You got a stock like this. Again, do you really need a stop? You don't. A stock like TJ Maxx, if I can get TJ Maxx up, do you really need a stop? You don't. These are the stocks that you buy and hold. And I know for some I'm talking blasphemy now, but it's really important. I saw kind of a long conversation this morning on Stock Market Mentor, and it was actually one that I kind of initiated or invited. And that is, you know, how am I using stops? I'm getting stopped out. I got stopped out 3 different times, and this and that and the other thing. And my point is, stops are, this is really important. Stops are risk management tools. Risk management. They're not trading strategies. There's a huge difference. You use stop to manage risk. In a stock like this, do you really think there's a lot of risk in TJ Maxx? Look at this. Is the stock going to fall from 34 bucks down to 28? Okay, if it does, even what is that? That's $6. We'll call that, we'll say that's 20%. It's really not, it's less than that, but I'm just doing mental math here. So let's say it's 28%. That would be a massive drop. Hopefully you'd have sold before then. What would be the more likely scenario if this stock's really going to fall out of bed? A move down here to the 50-day moving average, and then a move back up, like it did here, like it did here. So this is the extent, the likely extent of your risk right here. And so I guess you could put a stop down here. That would be fine. But the more a stock like this falls, the more likely it is that you're actually going to see buying coming in. So this is a totally different stock in which to apply stops than this stock, which is up so much. You know, a big move like let's say we bought right here at the close versus here. Okay, you had an 11% drop in like 3 days, 4 days. That's a pretty gut-wrenching drop. We could have had a bigger drop here. The point is, you just have to be using stops in a way that is in sync with the actual trading vehicle, in other words, the stock that you are trading. You don't apply stops in the same way. So here, as I mentioned on RenRen, you just keep a stop a little bit before 80, below 480, and I'm sure you're going to be fine on that trade. So either way, though, whether this is phase 1, 2, and 3, or whether this is phase 1 and we're just completing phase 2, the stock looks to me like here's your support level, here's your buy level, and look for that kind of move. Okay, members, I have 5 what I call right here, right now trades for you, stuff that's actionable right now. We're covering in total 19 stocks. So you got 5 possibilities I want you to get over, and don't blow off the video. They're not number 1, 2, 3, 4, 5. They're interspersed in the video. So do it now. Do not blow it off.